Bob, thoughts on the cause and effect, rhyme or reason for the post-inventories move?
Hey, Oliver, thanks for having me. Sometimes I feel like a broken record talking about crude oil on your show.
The longer the breath before the answer,
out exactly like
the more I feel like it's just a mess.
Well, okay, so here's what it is. I said this, I do some things for the CME group, and I said this on a video I did for them yesterday, that the important part of currently, it's always one of the more important parts for me, but the important part for today's EIA, and again, I said this yesterday, was refinery utilization simply because of the trajectory of it. When you're looking at, given the current environment in crude oil, the week-to-week draws aren't as valuable as they were during normal cycles. And I say that because it's not just a matter of we're close to 18% over the 5-year average in terms of inventories. So there's a lot of inventory. But if there's a trajectory of demand that the refineries think is happening, then you're going to see a floor in crude oil. And that's what I said yesterday. I thought that crude oil is basing and making a floor. We don't know what the ceiling is going to be of this new sort of horizontal channel that I think it's making. But we're looking at the floor being maybe around $39, perhaps on a big sell-off $37, but then that's likely to be bought. We had a 75 and change refinery utilization number. I'm sorry, 77 and change. We were looking for a 75, a 76. We had a 75 last week. We've now got 7 weeks in a row above 70. Prior to that, we had 3 weeks in a row under 70, and we have 5 of 6 under 70, and I had never seen that going back to 1992. So it's one of those situations where the outlook was so dire that just getting this refinery utilization number back to 80, which is normally a slow period, but given how it's been lately, 80 just looks like nirvana for crude oil longs. So it isn't the day, even though we had a 9.4 barrel swing versus market was expecting versus what they got, the refinery utilization number was strong.
So, Bob, this is pretty interesting. Is the refinery, I mean, they come out at the same time. The refinery utilization is part of the EIA report, but it almost seems like what you're implying is the market views that data point as being somewhat more either a trend, a more of a reliable trend, or more forward-looking. Is it less stale than the overall demand? Does it just suggest there's kind of a trend happening?
It's more about what's happening next week than what happened this past week.
Okay.
When you're looking at refinery utilization. That's why it's important now. It's actually generally in the first paragraph of the condensed PDF that you can find when it's released. It's one of the first things they put out, and it is what some of the hedgers and some of the professionals look at. You get these short-term speculative moves off of whether there was a build or a draw, and then you see the more sustained move that happens during the course of the day generally coincides with RU, more so than the build or draw, and that's been especially true lately.
Got it. Okay, and I've got it right now on the EIA website. By comparison, as you mentioned, we're getting closer to an 80% pre-COVID, 92, 90%, which is generally where you would expect to be. So it's in some ways, it's kind of like when we see the economic data points, we go, oh, there's 10% people unemployed or 9%. Well, we thought it was going to be 9.5 or 10.5. So we're moving in the right direction.
Exactly. I mean, we should be up in the 90s now. This is the start of the summer driving season, and the summer driving season cascades. So you get the South that has increased demand in May. You get the Midwest that has at the end of June, beginning of July, which is now. And then you have the East Coast that comes in August. The West is generally consistent demand all year long. So that's how the summer driving season sort of cascades. So we're in the midst of it. And the idea that they're, looking at where demand is, we should be in the 90s with refinery utilization. Moving back up toward 80 is a welcome sight for the longs.
Bob, to kind of talk some more of the macro here, and this is a little bit of a tough read anytime it is a read on what other people are going to do, but what's interesting is you've seen this big pickup in demand for cars and travel, RVs. People are like socially distanced traveling. And I know that it's coming at the expense of planes flying, which is not good for oil demand. But to what degree does it kind of offset? I mean, the summer months here, this could be pretty interesting to test, I would think, really how much this driving craze is going to help oil.
Yeah, OJ, I don't really want to stress, I don't want to overplay how high oil can go. I still think we're capped well below 50. But from a perspective of what you're saying, you were talking to, I believe it was Tom, you were talking to about gold, for example, right? I think this is more of an inflationary conversation, the demand for crude oil and then a potential inflation that could spike from what the Fed is doing and looking at what personal income is doing. That could actually pump up crude oil just simply as a matter of the commodity space rallying. Because we've got personal income rallying, which we did not have in the 2008 crisis. We had personal income declining. Now we have personal income increasing because government money's getting directly into the hands of consumers as opposed to it trickling down through TARP programs. We have it going directly to consumers, and we also have more money chasing what? Fewer goods because companies were shut down. So there's actually less inventory to sell. So crude oil can get a second bump from that. But currently what you're seeing is decline in jet fuel, but increase in gasoline because the driving is replacing that. But we're going to see an overall decline, both in a shift to EVs and just the sort of stay-at-home economy that we're likely to have for the near future.
Yeah. All right. So still headwinds for crude. I know that, as you mentioned, it capped, you said below 50. I don't see it on the list of positions that you sent over, Bob, but I do see the euro. I want to get your take on that before we go, because the dollar looks like maybe it's about to break to the downside. How are you trading the euro, and is the euro basically like a risk trade right now?
It is. The euro is a risk asset, and we're not really heavy in the tech sector, for example. The euro is acting like a risk asset. Mm-hmm. I do like it of what I consider to be the four majors, which is the sterling, the yen, the euro, and the dollar. I think the dollar continues to weaken. I think the EU has one of the least well-received stimulus plans in terms of the amount they may need to do more. And then you, of course, have the fear of the no deal UK-EU, which I think would actually push the pound lower. And if the pound's going lower and the dollar's going lower, the euro could benefit. We're long it. We're nearing our target. So I may not be able to have any of those come true before we exit it, because as I've mentioned to you before, when we hit our target, we exit, no questions asked. So we're not far from it. We're up a little bit of money, and we may be exiting it soon.